Hi, I'm Raghi Horner, and today we are going to leap into LEAPS. So what is a LEAP? A LEAP is an acronym for long-term equity anticipation securities. Now let's dive into what that really means. Longer term, for me that's going to mean a minimum of 6 months to hopefully multiple years. Equity, well, we're talking about trading stocks and or ETFs. Anticipation, well, I fully anticipate a LEAP to help long-term account growth. In terms of securities, well, remember, we are trading an option, which means it's a derivative of the stock. Why use an option? Why use a LEAP? The reason LEAPs are so popular is it allows us to buy something and get the benefit of margin. So if I were to buy a $100 stock and I want to buy 100 shares, I'm going to need $10,000 to buy and own that stock. But a LEAP is oftentimes a fraction, sometimes 20 or 10% of the cost of buying 100 shares. So for a lot of traders, that margin is worth it. Now, an example of a LEAP setup would be if, for example, the stock that you wanted to buy sank down to $100, instead of buying shares, you would use that $100 as a trigger to buy a LEAP. I prefer to buy at-the-money LEAPs with at least 12 months to expiration. LEAPs can be 1 to 3 years actually before they expire. So you can have a lot of time in that LEAPs. So ultimately, the cost of the LEAP is going to be how deep in the money the option is and how many years before expiration, which, by the way, is like it would be really for any other option that wouldn't be considered a LEAP. Let's think about the pros and the cons of LEAPs, though. Number one is time. The more time to expiration, the more expensive the LEAP is going to be. The less time to expiration, the less expensive. The dividend is another part of why we might think about LEAPs versus shares. If the dividend that the stock yields is high on your list of why you want to own that stock, the stock might be the better way to go because you're not going to benefit from the dividends directly when buying a LEAP. The last one is expiration, and this has to do with the longer term account growth, which is what I'm really after when I'm buying shares or LEAPs. LEAPs are a depreciating asset like any option, and the closer we get to that expiration, whether 6 months, 1 year, 2 years, or 3 years out, it will start to depreciate. The idea is if I buy shares and I buy them without margin, I bought 100 shares of whatever stock, those stocks are mine. Those shares are mine. But in the case of an option, the case of a LEAP, as we near expiration, that LEAP will eventually expire. And at that point, I can choose, of course, to exercise the option, but I would still need the cash. Or I could choose just to profit from the appreciation of price of the LEAP. So time, we're always going to pay for it one way or the other. Dividends, how important is it to your account to get that dividend? And lastly, remembering LEAPs will expire. Ultimately, whether to use a LEAP or shares are choices, and choices are great. You can choose to have a combination of LEAP and share. You can choose to go with the LEAPs only or shares only. But now that you know what they can help out with, remember, one of the best things they can allow us to do in our longer term account growth is allow us to have a smaller amount of money and yet control 100 shares of that stock for each and every LEAP.